Hi everyone, and welcome back to the second video, second little prep video for our finance case challenge on the topic of make or buy. And in that second video, I would like to give you some more insights on investment decision criteria or investment theory if you want. So although I try to make it as applicable as possible and draw as much connections as possible to the make or buy decision. Yeah, so let me get into the slides. Just one sec. Okay, there we go. So chapter number 2, just as a reminder, the very first video gives you a little bit of insights, what is meant with that make or buy decision, what might be motivations, and a little bit of examples, and also what are dimensions to judge this make or buy decision. And what we found out there was A, the investment amount, the initial investment is super important. B, the cash flows and how they look like over time are very important. So this also plays into the area of what is the speed of implementation, so to speak. And then the underlying risk is also pretty important. So is the one or the other maybe less or more risky? That's also something that we would like to figure into our decision. Yeah. On top of that, we talked about flexibility and learning. That's a little bit harder to capture. Flexibility really needs some advanced approaches, real options, to be honest. It's something that is totally beyond the scope of the case challenge, but definitely something that is in the scope of a master's program. So if you're interested in that stuff, just let me know during our case challenge day, and then I can give you a little bit more insights on that one. Yeah. But in this video, in this chapter, we are going to talk about evaluating different investment options. And I want to start with the most important and famous concept that we use in corporate finance, and that has many connections to the topics that I just said. Yeah, timing, risk, cash flow characteristics, also let's say the long-term horizon of an option, of an investment option. That's all priced in. Okay, so enough of a prologue. Let's go into that. Yeah. So what is basically meant when we talk about a present value? Yeah, little introductory example. And let me maybe also say, if you already know from your bachelor's what a net present value is, then probably you can skip like the first 10 minutes or so and rather come back when it goes into free cash flow determination and the cost of capital. Yeah? But for everyone who is not so familiar with that, or who thinks needs a refresher, here comes a little bit of very basic theory on that. Yeah? So the idea of present value can basically be boiled down to the following example. So let's say I give you a choice. You can either take 100 euros today from me, or you can take 110 euros from my side in 1 year. I give you that option. Yeah, so you can decide either way. And the question is, what would you choose, right? And there are several factors that will make that decision work out for you. The most important basically is, what can you make with the 100 euros if you take them today? Yeah, so could you invest them and maybe in 1 year you have more than 110, maybe you have 120? I mean, then it's a low-brainer, right? Or if you say you have something you want to spend the 100 on that has a much higher utility than having 110 in 1 year from now. That's not so easy to figure out, and that's also not how corporate finance works. We would basically focus on the very first dimension. So the question is, what can you make with your 100 today? And is that more than the 110 in 1 year? Yeah, and obviously it depends. Yeah, sometimes you have the opportunity, sometimes you don't. What is important is that investing the 100 today if you want to compare it to the 110 in 1 year, it has to have the same risk class. So obviously, waiting for me for 1 year to come back and give you 110 comes with a certain risk. Yeah, I mean, I'm a super responsible, reliable person, but I'm obviously not the European Central Bank. Yeah, so there is some risk attached to me. And probably also, if you want to invest the 100 today with a return higher than 10%, that probably also comes with some kind of risk. And the risk classes have to be comparable. Yeah. Okay. So that is the basic idea. We want to make cash flows from different periods somehow comparable. Yeah. And the way we just discussed it was a little bit that we thought about taking the 100 today and thinking about what is it worth in 1 year. And that's fine. That's the basic principle also of the present value concept. But what people do is, in the real implementation, is they would just turn that whole thing around. They would say, okay, a cash flow of 110 in 1 year from now, what is that worth today? Yeah, so we call that, we discount a future cash flow. Yeah, so 110 in 1 year, what would I need to invest today to basically arrive at that 110 in 1 year? Yeah, that is the underlying question. And you see that this is basically just turning around the argumentation from before. Yeah, the idea is the same. We need some kind of return between year 0 and year 1. The reason why people do that and try to bring back all future values to today, that's the reason why it is called present value, is that it is easier to compare if you take cash flows from year 1, year 2, year 3, year 4, year 5, and you bring them back to year 0, than to do something the other way around. Yeah, so calculating like one future value gets a bit messy because you have so many different future periods, but bringing everything back to today, that's rather easy. Yeah, so that is the reason why we do that. And here you can see on that slide how that is done. We basically take the cash flow in 1 year from now, and we discount by dividing by 1 plus R. And it really just stems from the idea that you could also say, hey, I compare that with a today's investment, CF0, which which has a return of 1 plus R, and this I compare to CF1. And you can basically obviously just turn the whole thing around, and this is what the net present value principle does. Yeah, and now translating that back to my 100 and 110 euro example would mean, hey, we give up on 100 today, so that's the reason why this is minus 100, but we earn 110 in 1 year. And now let's say if that is on a 5% discount rate, an R of 5%, then the net present value here would be positive. And if it's positive, then we would say, hey, that is a good decision. Yeah, so waiting for 1 year and taking the 110, that would be a good decision. If R would be 15%, so if my opportunity costs would be 15%, if I could take the 100 today and rather invest it at 15%, then it would be a pretty bad decision to wait for a year. Okay, so that is the way how it works. Yeah? Okay, so then let us move on. That was the idea over one period. So now the thing is, of course, that you can also do that over several periods. I already mentioned that, and the idea is pretty simple. You always just add the factor of 1 plus R for the next year. Yeah, so if you want to discount from year 2 to year 0, then it is basically taking the cash flow and dividing it by 1 plus R to the power of 2. 3 years, 1 plus R to the power of 3, and so on and so forth. Okay. So basic idea is, the further out a cash flow lies, yeah, in terms of timing, the less it is worth today. Okay. And here's a little bit of an example, super basic one, like what is the impact of different opportunity costs? Yeah, so 0%, 5%, 10%, 15%. If I talk about opportunity costs, you could also say discount rates. Yeah, so it's pretty much the same. And as I told you, the difficult part is to figure out for any kind of investment, what is the appropriate discount rate or the appropriate opportunity cost. And there is a whole lot of a concept around that. And that is what we're going to talk about at the very end of that video. All right, here's a little exercise. In order to keep that video short, I'm not presenting like how I'm solving that step by step. Yeah, but here you have a task. You can basically try to do it yourself. It's really very, very basic. Yeah, so if you have worked with NPVs beforehand, no need to do it. If you haven't, then just give it a try. On the next page, you also have the quick solution to that. Yeah, so I think it is quite self-explanatory. I'm going over that, but here you can basically practice for yourself. Okay, very good. And then there are some special cases, I would call them. So far we said, well, there could be a cash flow in year 1 or year 2 or year 3, and you discount it back to today. Yeah, and that's fine. That always works. But sometimes you have investments that are at least expected to have a very long time frame of payoffs or of cash flows, and maybe even to maybe even to infinity. Yeah, and that would basically mean that we talk about something like a perpetuity. This is very common in corporate valuation. Yeah, so first of all, we think that companies are there forever. Yeah, that might not be true in reality, but it's kind of the best guess you can do. And since we are discounting cash flows, it anyways doesn't matter whether a company only survives 150 years or 1 million years, because all cash flows after, let's say, year 150 have a very, very low present value, pretty much close to zero. Yeah, so therefore we can directly assume that the company lives forever, because the great advantage of this is that the sum formula that you see over here, yeah, so that would basically mean we have cash flows from year 1 to infinity. Yeah, that's the sign for infinity here. This crazy sum formula totally collapses or simplifies to this very, very simple equation. Yeah, and that's cool. So you just need the first year's cash flow of that perpetuity, where you say, okay, from now on the cash flow stays constant, and then you can just divide it by a discount rate, and that's it. And you could even build into that some kind of growth rate, as you see over here. Yeah, so if you want to say, hey, there is a constant growth rate year after year after year, I don't know, due to inflation, for example, then you can basically build that in. The equation collapses to that. Again, very, very simple. And what you can also do, but to be honest, in the context of M&A, that's not used too often, is you can also have a cash flow stream that has some kind of end somewhere in the future. Let's say after 30 years, there will be an annuity. You've probably heard about annuities. A lot of loans are annuities. If you want to build a house, if you want to take a credit for buying a car or something like that, then it's pretty often an annuity. And also for that one, ready to use formulas out there. Yeah, in a master's program, we would go also a little bit deeper on that, would really try to understand why does the formula look as it look, and that would basically enable you to use it for all different kind of investments. Would be too much for that video, also too much for the case challenge. But on that slide, let's say you get guidance on those special cases and ready to use formulas. Yeah? And the beauty of that whole present value concept is basically that you can combine different cases. So let's say you have a detailed financial planning for the next 3 or 5 years of a company or of a project. Yeah? Then you just take, okay, the cash flow of the first year, I discount that, of the second year, I discount that, and so on. And after year 5, you say, well, I think that's kind of a steady state. This is when cash flows kind of keep constant or they keep constantly growing. And now the cool thing is you can just put that together. So for the first 5 periods, you take that very simple formula, cash flow discounted back. And for the periods after, for the steady state, you take that perpetuity formula or that growing perpetuity formula. Yeah. My unfortunate drawings here, yeah, I'm very bad in that. Try to show that. Yeah. So here it's like super. It's like super varying. Yeah, up and down, and then at some point you basically go into that steady state. Yeah. Okay. Very good. So that's important to keep in mind. And again, also for that, there is a little exercise where you can basically practice this. Some numbers, it's about a funny startup, I would say, or foundation of a company. It's about computers and software, and you basically have to figure out what is the value of that company. It has a certain cash flow profile, and in the second part of the task, you should figure out what is your willingness to pay if your friend, who is the initiator of the company, is basically offering you a certain share. Yeah. So if you want, try that out. Nice little example, I believe, to practice the present value. And also here, you basically have the solution on the next 2 slides. Yeah. Okay, very good. What else to say? I mean, I already told you that we would basically undertake any kind of investment that has a net present value greater than 0. And that's true. That's the classic NPV rule. Whenever projects are independent of each other, then we should do everything that has a positive NPV and NPV greater than 0. If you have mutually exclusive projects, then you should take the one with the highest positive NPV, and make or buy is very often mutually exclusive. Yeah, so you can enter a market obviously just once, either organically, yeah, by building up your own operations there, or inorganically by basically taking over some kind of local competitor. Yeah, so doing both is usually not very meaningful, so that it would be mutually exclusive. So if we compare such 2 options, we would basically have a look on what holds the higher NPV for us. Okay, then maybe the very last sentence regarding the NPV. Back to, let's say, what have been our decision criteria in the first video. So definitely what the NPV is pretty good at capturing is initial investment. It's pretty good in capturing the speed. It's pretty good in capturing the risk. The risk is something that we would put into the discount rate. Already told you that needs a little bit more of concept. Yeah, so far I just told you, hey, might be 5%, 10%, 15%. Yeah, so we need to figure out where that comes from. But also that is something that the concept can basically figure. Another thing where the concept is pretty good at, obviously, is capturing the characteristics, size, nature, time horizon of the cash flows. Yeah. Where the concept is not so good is when it comes to more qualitative factors like the flexibility, like the learning effect, skill effect on the company. And maybe one more thing on risk. Yeah. There are certain risks that are also super hard to factor into a financial concept, which is, for example, what are my capabilities in basically implementing the one or the other option. Yeah, so this comes also a little bit to that skill discussion. So how good am I to really set up a new company or subsidiary in some other country? Yeah, so I don't know, I'm a German food manufacturer and I want to expand to Brazil. I have no clue about the language, the culture. I have no clue how to set up the logistics between Germany and Brazil. There is a time zone gap in communicating with senior management and so on and so forth. Yeah? So those factors is also something that is very hard to capture in a net present value concept. And therefore, and that's my point, we always need some kind of strategic discussion next to that, qualitative assessment next to that, so that the net present value, let's say, is one part of our decision making. As we also in our master program always try to put it, is basically we make decisions at the crossroads of finance and strategy. Yeah, so everything has to be reflected, and then we can really make a well-informed decision. Okay, that's my last note on the NPV. So what else is in here? Subchapter B basically shows you some other investment criteria. We should, sounds a bit stupid, but we should usually stay away from those others, yeah, because the net present value is the best concept to use, the only one that really delivers reliable results always. Yeah. Nonetheless, I want to introduce one more thing, because as the graph on the right shows, there's one thing that is very frequently used, which is the IRR, the internal rate of return. And actually, the internal rate of return is something that is not so different from the NPV. Sorry, let me maybe first show you the whole slide, because otherwise it looks a little bit weird, right? So we go through like this. So the IRR, as I told you, is not so different from the NPV. It's actually exactly the same formula. Yeah? So you have cash flows that get discounted, and you have an initial investment. But now you are turning the whole thing around. You are not thinking about what is the discount rate or the opportunity cost that delivers an NPV, but instead you say, hey, I set the NPV equal to 0, and I see what kind of discount rate would generate that NPV of 0. Yeah, same equation. You just say, okay, the NPV is known, that's 0, and I rather try to figure out the discount rate. Usually you need Excel for doing that, at least if you have more than 2 years in your cash flow planning. I think that's on the next slide of how that can be implemented. Rather easy, very simple. Also something that we can talk about on Friday. But then you have that. And now, how can you decide whether it is a good investment or not? Well, you still need somehow your discount rate. Yeah. We usually call it, by the way, WACC. I introduced that concept later on, weighted average cost of capital. And we would see whether this WACC, or that discount rate or opportunity cost, is basically greater or smaller than the IRR. If it is smaller than the IRR, then it's a good project and we should do it. If it is greater than the IRR, then we shouldn't do it. Why? Because the discount rate tells us what is my best alternative, or how much are my investors expecting. And the IRR tells me what is my average annual return from that investment. And if this is lower than what is expected in that risk class, then I shouldn't do it. Yeah. And from that end, whenever we are talking about independent projects, the IRR also delivers very reliable results, just the same as the NPV. Disadvantage of the IRR lies mainly in the area of mutually exclusive projects, because it can well be that you have a project that has a higher IRR than the other one, but that basically delivers a lower NPV. And this is due to the fact that scaling is pretty much ignored by the IRR. I do not want to go into all detail here, yeah, but that is really an issue to take care of. And also when we work on the case, and if we should, let's say, be in the position that we need to derive investment decision criteria, we can then also together in the group works discuss a little bit about that. And you will quickly see that the IRR can lead to some very dangerous results. Yeah? So please keep that in mind. And on the next slides, I mean, first of all, there is some example of like really a numerical example of like how it is implemented. Here you also see the Excel formula that can be used in the English and the German version. And I believe, yeah, here it is, great. I believe there is also one slide that talks about all the pitfalls or disadvantages of IRR. And what I'm referring to, and which is the most important for us in the make or buy decision, is basically pitfall number 3, mutually exclusive projects here. Yeah. And there you can see it's like the most simple example you can ever think of. Yeah, it's just investing something in year 0, getting something back in year 1. And you see that the IRR is higher for project D, as we call it, 100%, but the NPV is lower, yeah, than for project E. So both criteria would lead to different results, and the NPV should be the one that you follow. Why? Because the NPV really tells you how much value is created from an investor's perspective as of today. Yeah, and that's much more here. Yeah, so 3,700 roughly more than with project D. If you wouldn't do it, you would basically give up on that value, and that would be very stupid, although your relative return is higher with project D, but project D is also the much smaller project. Yeah, so definitely take project E here. Okay, I hope that example made it a little bit more clear, but as I said, otherwise that's something that we can perfectly discuss on Friday. All right, so that already brings us to the third subchapter, which is cash flow determination. To be honest, it's a bit a challenge to put that in 10 minutes or so, because you could basically talk a day about it. I try to give you a little bit of a summary. Yeah? So first of all, when we talk about cash flows in that present value concept, we definitely talk about ex ante projections. Yeah? So projections going forward. We are not so much interested in financial statements and what you find there in the cash flow statement. The things are related. If you have questions to that, happy to answer them during our day together. But we rather want to derive our own so-called free cash flows. Free cash flows are, so to speak, cash flows that are available for being distributed to investors. And there are two different concepts, the free cash flow to firm and the free cash flow to equity. So let's have a look into them. Free cash flow to firm, free cash flow to equity. Yeah, so on the left, firm, on the right, equity. And I apologize a little bit for that quite well filled up slide here. Yeah, but I think it has all the information that you would otherwise put in a whole lecture. Yeah, I'll try to guide you through. Okay, so let us maybe even start on the right with the free cash flow to equity. The basic idea is that you come from the profits, from the P&L, the profit and loss statement. Yeah, so there, as you hopefully know, yeah, you have sales or revenues, then you have some kind of operating costs. You arrive at an EBITDA, and then you can basically deduct the depreciation, you arrive at the EBIT, you deduct the interest, arrive at the EBT, earnings before taxes, then you deduct the taxes, and you arrive at the net profit. That's really the result of the profit and loss statement. Yeah? And now the thing is that profit is not exactly the same as cash flow. There are certain things that are left out in the profit and loss statement, and then there are certain things that have been taken in, but they are not cash relevant. And the very first thing to think about is the investment behavior. Yeah? So if we invest something into our company, let's say we buy a new machinery, yeah, then what is happening basically is we have a cash outflow. Yeah, we buy this machinery, we have to pay it. And this is not getting into the profit and loss statement because it's not an expense. It is something, it's an investment. Yeah, so that means cash goes out, but something goes into property, plant, and equipment on the balance sheet. Yeah, I'm not doing an accounting lecture here, but just trust me, it's definitely not reflected in the P&L. So therefore, everything that is a capital expenditure needs to be deducted from our net profit. On the other hand, after you have invested, let's say a year later, you have a depreciation on what you have invested. So let's say the investment has a lifetime of 5 years, then the first 20% of the investment are depreciated in year 1. The next one in year 2, year 3, and so on. Yeah, and that is something that we have in the profit and loss statement. It's also important that it is there because it reduces our tax burden, but it is not a cash outflow. Yeah? It just happens on paper. And therefore, if we want to calculate our cash flow, we have to add it back. Yeah? So it comes back into the cash flow, has a plus sign here. Okay, and this is area A, I would say. Yeah? So this is about investment behavior. By the way, those numbers, letters A, B, and C have or are explained in further detail on the following slides. Yeah, so if you go through the material, if you have that time, as I said, it's totally voluntary, but here you would get some more information, and basically what I just put in a few short words, you see that here written down how it works and why it is necessary to basically make that adjustment. Yeah, it's here for A, it's also there for B, and also for C. Yeah, but let me stay on that summary slide and let me try to work. To work through that. And as I said, you have always the opportunity to go deeper into the detailed slides if you really feel, okay, that is something that is still necessary. The second thing is change in net working capital. And that's probably the one thing where you may want to have a look at the supporting slides. The change in net working capital describes everything that you basically need to run your operations on the balance sheet. Yeah, so sounds maybe weird. So I try to give it 3 examples. First one is your inventory. Yeah, so if you produce something, then obviously at some point in time you will have something in your inventory, right? So you buy materials, you produce something, you sell it off. There will be at some point something in your inventory. That's working capital. Yeah, so that is something that you need where cash is bound, so to speak, to keep the company running. Second thing is accounts receivable. So those are sales that you generate with your customers, but where the customers have not yet paid. Very common in B2B business. Yeah, so you send them the product and the invoice, but the invoice says, hey, please pay within the next 30 days. Yeah, then those 30 days of sales is basically an accounts receivable. And this is also capital that you have not yet collected. And therefore, it's part of that working capital. And obviously, there is exactly the same on the supplier side. So stuff you buy and you have already, you got it already delivered from the supplier, but you haven't paid it. Yeah. So here it's the other way around. This is like a credit, yeah, not money that is still missing, but basically money that is given to you as a credit by your suppliers. And all 3 positions together is what we usually call the net working capital. And my favorite slide to explain that is, where is it? Sorry, this one. Sorry, is this one. Yeah, so here you basically can see how it is calculated. Here you have inventory stuff, raw materials, finished and unfinished goods, and those accounts receivable. And here you have accounts payable. There might be some other stuff. We can talk about it on Friday if you like, if that is part of the case, but usually those are the important ones. Yeah? And the difference between the 2 sides is basically the net working capital. And that is what you usually have to finance with your long-term capital. Yeah? So the bigger that gap is, the bigger that net working capital is, the more of expensive capital you need. Debt is expensive because I have to pay interests. Equity is expensive because my equity investors, they will always ask for some kind of returns. They have expectations, they want to have a dividend, and so on and so forth. Okay. So that is net working capital. And now what means delta in net working capital or change in net working capital? Because that is basically what we reflect in our cash flow calculation. And the idea is maybe best explained by that little numerical example here. Here you see a net working capital of 70 in year 0 and a net working capital of 90 in year 1. That means the net working capital increased from one year to another, mainly because we have more in the inventory and because we have more outstanding sales, so more accounts receivable. Now that means that less cash is available in our bank account, more cash is bound in our working capital, in our operating process of running the business, and that is not at all reflected in our profit and loss statement. So we have to reflect it somehow when we calculate our cash flow. And therefore, whenever the net working capital increases from one year to another, we basically decrease our cash flow by exactly that amount. And that is what you can then basically see here in our fuzzy slide. So change in net working capital with a minus and a plus means to symbolize, okay, if the net working capital goes up, the cash goes down, and the other way around. Last but not least, on the way to our free cash flow to equity is the change in interest-bearing liabilities or the change in debt. I think that is, again, very straightforward. If I take a new loan, if I increase my debt by 100, I have 100 more cash available. So therefore, cash flow increases. Again, that's nothing that is reflected in the P&L. So I think the last one is very simple. And then we arrive at our free cash flow to equity. And let me directly tell you that the appropriate discount rate for such a free cash flow to equity would be the cost of equity. We are not going to go like in the deepest detail on those discount rates because this could be a full course actually. Let me just make a reference because the one or the other of you has already seen it, I guess, during the bachelor studies. That's something where you would use this capital asset pricing model. For the case challenge on Friday, it is not necessary to derive costs of capital yourself. Basically something that will be given, but at least I wanted to give you that reference here. The second potential cash flow concept is on the left. That's the free cash flow to firm. Actually, a lot of things are the same. There is just one weird difference. We regard the company when it comes to the cash flow as if it would be 100% equity financed. That sounds a little bit weird. So let's say there is a company that has also debt holders involved, but we just ignore them, so to speak. So we treat the company as if it wouldn't need to pay interests, and therefore also the taxes that we calculate and deduct are different because we take the tax rate directly on the EBIT. Usually you would always take it from the EBT, but we don't. We take it from the EBIT. So we have too high tax expenses actually. Therefore, we are also arriving at something that is different from the net profit. We arrive at something which we call the net operating profit after taxes. Then the adjustments after that are the same. Depreciation, amortization, capital expenditures, net working capital. Obviously, we do not account for the change in interest-bearing liabilities. Why? Because we treat the company as if there wouldn't be any debt. So therefore, this position is also gone. And what we then arrive at is the free cash flow to firm. And the idea is that is a cash flow that is, so to speak, independent of the capital structure. That is really just what the operating firm, so to speak, generates. And why people are using that, and to be honest, it is used much more frequently than the approach on the right-hand side. So the reason why people use that is because they rather want to factor in that effect of debt and equity into the discount rate. They want to really know what is my appropriate discount rate under partial debt and equity financing. And they do that with a discount rate, which is called the weighted average cost of capital, as you see below. And now I know there are a lot of crazy signs in here, but if I give you a little bit of an explanation, it will be super simple. And again, during the case challenge, that is something that we will provide and it will be given, because that needs much more theory. But again, I would like to give you a little bit of reference into the topic. Yeah. So why is it a weighted average cost of capital? Because on the one hand, we have a cost of equity that is called RE. The L is a reference to the fact that this is a levered cost of equity. So the higher the leverage, the more debt is involved, the higher is also the cost of equity. That is what it tries to say. But what it basically is it's the cost of equity. That is what my equity investors expect from me. That's their opportunity cost, yeah, their discount rate. And then we have RD. That's exactly the same thing from the perspective of the debt investors. Okay, so we have basically cost of equity and cost of debt. And for both of them, we simply have their weights. Yeah, so E0 is the amount of invested equity in year 0. D0 is the amount of invested debt in year 0. And EV0 is the sum of the two, E0 plus D0. In the last subchapter, there is more details on discount rates, and then also the different notations are explained in more detail. Yeah? So if you need that written down and not just commented by me, you'll find it there. Yeah, but really, that is just the weight of the equity, and that here is the weight of the debt. And now think about it. You have cost of equity with the weight of equity, and you have cost of debt with the weight of debt. So this is the weighted average cost of capital. The only thing that is a little bit weird here is that strange 1 minus tau. And that is the tax advantage of debt. Here in the free cash flow to equity, I just told you, hey, we deduct interest, then we arrive at the EBT, and that is our base for calculating the taxes. What that means implicitly is that paying interests to a bank or to debt holders is basically subsidized by the government. Yeah, so you pay 5% of interest to a bank, but basically if the tax rate is 30%, then 30% of those 5% you get back. So effectively, you just pay 3.5%. And since we have ignored that here in the cash flow calculation, we are now putting that into the discount rate. So if the credit contract says, hey, the interest rate is 5%, then we know that effectively we just pay 3.5% if the tax rate is 30%, right? So therefore it's 5% times 1 minus 30%. So in total, the net cost of debt is just 3.5%. That's the reason why we have that 1 minus tau here. Tau is the corporate tax rate. Good estimate for Germany is basically 30%. Yeah. Okay. Yeah, and then you basically have an idea about cash flows. You have an idea about discount rates. As I told you, you have some more detailed information on the different adjustments of the cash flow, A, B, and C, on the subsequent slides here. Yeah, I'm not going through them, but maybe they are helpful to illustrate a little bit more what I talked about. And then you also, as I told you, have some more information regarding the discount rate and some more explanation. Actually, I think I talked about all that stuff verbally, but you have it here also written down. What is that cost of debt? What is the capital structure? What is the cost of equity? You'll find it here. And I also gave you some information on that capital asset pricing model, yeah, that is used to derive the cost of equity. super cool topic, definitely something that we are also discussing in our finance program a lot, in particular how reliable it is, what other alternatives are out there, and so on and so forth. But would be way too much for that video and also way too much for the case challenge. So that is definitely something that is just provided ready to use, so to speak. Yeah. But you have some more information in here, and I think that's if you have some time, that might be a nice read. Okay, so that was the second little video snippet. I hope that was nothing that made you fearful or something, because I know it was a lot of information, but Friday will be much simplified. Yeah, so a lot of stuff will already be given to you, but I wanted to give you the chance. It's also the reason why I said from the beginning that it's voluntary. I just wanted to give you the chance that maybe if you want to get some more background information, maybe also after the case challenge, that would be your chance. Okay, so therefore I wrap up video number 2, and if you like, you can then watch video number 3 on valuation and M&A. Yeah, thank you very much and see you. Bye.